Hi, welcome to the It's Your Money and It's Your Estate Spring 2025 workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Now, let's start the program. This webinar is the 6th and final session of the It's Your Money 6-week program. The topic of the day is Financial Planning Part 2. Our moderator is Peter Kote, and our guest speaker is Delia Fernandez. Enjoy the workshop.
Delia, come on, line. Yeah,
Absolutely.
good morning.
Good morning.
And we're going to kind of go through this is our last session. So you have the honor of summarizing 6 weeks of programs for us. And I'm going to start off with a little bit about your background. How long have you been in the biz?
Boy, I've been in the business just a little over 30 years.
30 years. And you are a fee-only fiduciary financial advisor?
Yes, sir.
And have you been that for your entire career?
Well, not the entire career, the entire time in this business. I'm a career changer and I came from PR and marketing.
Okay. So, how do you charge your clients?
I charge on a fee-only basis either for hourly help at $3.50 an hour, or I manage assets under management, assets under management. I start around 1% a year, but it depends on the nature of the client.
Okay. Do you give a free look? Do you review individuals' financial plans
Yeah,
or
if a client
financial?
wants to come in and show me something that they'd had done in the past or talk about how we might work together, certainly there's no charge for that.
And do you get any monies from any other source besides your client?
No.
No,
I
you
won't take
don't.
it. I won't take it. Not even those little gift cards that they want to slip in
Yeah, I know.
under the lunch table.
It's so common in this industry, you know. Do you take or give referral fees?
No,
Yeah. So the only person that you really are beholden to is the client.
that's exactly right. And
Yeah,
I became the kind of planner as a career changer that I thought I would want to hire if I ever needed a planner.
yeah.
To me, this is all very important and very personal.
Do you have a minimum?
I don't have a minimum, although most people, if they wanted me to manage their assets, would probably be better off hourly before about $100,000 or more.
Yeah. That that's where an hourly or two meeting is usually all they need.
Absolutely.
Yeah. And the thing of it is that we all think we know everything there is to know about money because, I mean, where did you learn about money?
I was in a part of the financial world. I was in the credit business for several years with TRW's credit reporting division. And then I decided to get my CFP training by going through a program at UC Irvine Extension, which I then taught in for a little over 20 years.
Yeah. How about your parents? What kind of money attitude did they have?
Um, They didn't have a lot of money, so we had to scrimp and save. And my mother was a Depression era baby, so you know about Depression era babies.
Yes.
That penny really squeaks.
Yeah, exactly. Yeah, how we grow up and learn about money is just so huge. It just has a total impact on us. Um, let's see. If somebody else, because this is kind of the final session, what three things should a person who's looking for a financial advisor, not just you, what should they use just on a practical basis?
Well, we all have to have a Form ADV for advisor that we give to our regulators, we file with our regulators, and that we give to potential clients.
So
We
the
all
ADV form you have to give out to each client, prospective client.
Prospective client. If they never hire me, I have to give it out to prospective client. We have to have a link to the broker check website on the first page of our website. And broker check is where you can go and see not only click to the ADV, but also see if there were any regulatory problems or concerns about the advisor.
Okay.
And
So
then I,
so the three things are the ask first form,
and the ask first form.
yeah, the ADV form, and then do broker check.
Yeah. Pretty
Okay.
straightforward. I mean, you can learn a lot on broker check,
Oh
Form
yeah.
ADV.
Yeah.
Ask first flashes out some of the things that you've been asking me.
And then who do you use as a custodian?
Charles Schwab.
Okay. Um, you know, when we go through this, people think that this is very, very complex. Uh, it doesn't have to be. The investment part is probably the easiest. And we'll talk about that when we get to the investment part. But let's go through the things that somebody must know. But let's bring up your outline and we'll get
Okay,
started on
let's go
that.
take a look at that outline. So I'm going to pull that up. Um, and um, and the outline I know is online. It has how to get in contact with me if you needed to. And today I want to remind everybody, because I think you've been hearing this through the weeks of this program, some of the key things that you need as part of a plan. And we have to start and end with a financial planning process. When somebody asks an advisor something, they don't realize that we're going through this checklist in our head.
Delia, I'm seeing your side notes on that or the side.
Oh, I see what you're saying. Well, let me
Can you
make sure that
expand it
that
on the
doesn't.
screen?
Is this better?
There you go. You
Sorry
got
about
it.
that.
So let's stay on the other. Well, you know what? Yeah, let's go through the process.
This is what an advisor is thinking about when anybody asks them a question. Do I know my client? Do I know their circumstances? Do you know, as a potential client, do you know your own goals and do you know their priorities? It's interesting how many times we ask a client, what do you really want? And they're like, I want a lot of things. But when it comes down to the money, we've got to be able to prioritize because most of us don't have an unlimited amount of money.
Yeah,
And
yeah.
then we have
Do
to
you
figure
do,
out
do
what we're
you
going to
try
do.
to narrow it down to 3 to 5 kind of goals?
Sure, I definitely do. I mean, obviously, sometimes a client is talking to me about the big picture in retirement, and sometimes they're trying to decide on a particular action. Can we afford this bigger home? Can we afford to send the kid to this college?
Yeah. And
But
then that's where you have to go back and say, hey, do you understand your personal and financial circumstances? So
exactly,
what is your net worth? What is your cash flow? How much risk are you willing to take to get there?
that's exactly it. And what would it do to all your other goals if you took this one action,
Yeah. Yeah.
right?
Do you do a lot of what ifs on paper?
Yes, or on the software. It's great to be able to put it into the software and do what ifs and show the client, well, yeah, let's go buy that other house. Or let's send all four kids to very expensive colleges and see when you get to retire.
Yeah.
Um,
Yeah.
and
So then you got the course of action, potential alternatives, financial planning recommendations. You've got implement the plan and monitor the plan.
right.
We talked a lot about that. We haven't talked much about monitor and update. Are you going to go through that after a little bit?
Yeah, we can certainly discuss it because every year potentially your situation could be different. That's why advisors want to see a client's current tax return. It's a great place to start. Let's get an update. Let's see where you are with your taxes.
Well, that's one of those must knows. Okay. Besides net worth, besides cash flow, you must know your tax bracket or your
Yeah,
marginal tax bracket.
let me
Let's
show
take a
you
look at it.
Let me show you a great handout that I have, and I've given it out before, and it's certainly available for you guys to put on your website because it's free. It's from this one happens to be from a company called Voya. But what we've got here are your federal income tax rates on the left-hand side. Now, we may all have a standard deduction. 87% of the people in the country
You know,
take
it's up to 90.
Is it 90 now?
90 for those individuals that are over 65.
And those standard deductions are right down here at the bottom. If you're if you're over 65, you're getting a little bit extra. Singles are getting 2,000, married filing jointly are getting 1,600 extra on their standard deduction. And then after you subtract that standard deduction, you really, really need to know what your marginal tax rate is, which is the next dollar that you make, how is it going to be taxed? That's what advisors care about. That's what our clients should care about because this is the impact of your decisions.
There is not much of a difference between the 22 and the 24%.
No, there's
But
really
there's
not.
but there's a huge jump between 24 and 32.
Yes, which is why a lot of the strategies that we use that are tax strategies, like should we convert your IRA to a Roth? Should you maybe fill up a tax bracket when you retire by taking more money out before you have to take required minimum distributions? A lot of those recommendations are focusing on that 22, 24% tax bracket range.
Yeah. I've heard that you need to be in the 32 to the 35% tax bracket to have municipals work for you.
Yeah, a lot of people will come in with municipal bonds, which are, if they're California and you live in California, they're double tax free, federal and state. And they're leaving money on the table because they say, well, I don't want to have to pay taxes. And I'm like, yes, but it's not what you make, it's what you keep. And you're not keeping as much. You know, you could be keeping more if you had a taxable bond.
Yeah. Yeah. And, if you have a recent death in the family,
Oh,
or you've got, all of a sudden you're going to be your Social Security is going to be different, your tax bracket is going to be different. You don't have a partner there to discuss your money, and who do you trust?
that's
Um,
exactly it.
you know, in filing tax returns. Do you find that most tax accountants give advice on taxes?
A lot of them do not do tax
Yeah,
planning. A lot of them don't have the time or the interest. There was an accountant who said they went to a recent CPA professional meeting and that 70% of the CPAs in the country were of retirement age. I mean, we don't have enough of these people and they're not doing tax planning.
yeah. Let's go to the next slide.
Okay.
One thing I just noticed capital gains and qualified dividends. Why do we need to be
Yes.
aware of those?
Oh my gosh, if you have taxable investments, something in a brokerage account that's not in a retirement account, you have a great opportunity to get a lower federal tax rate, not California, but a lower federal tax rate, or maybe even a zero tax rate, if you sell an investment that you have held for a year or longer. That's called a long-term capital gain. And look at these tax brackets for a single filer, not over 48,350. They could be in the zero tax bracket. They could have up to $533,000 at a 15% tax bracket. I just helped a married client, married filing jointly last year. He'd been underemployed because he'd gone through a layoff. We were able, because of this capital gains chart, and because he was living in another state where they didn't have state income tax, we could take capital gains for him up to $96,700 on the sale of a stock that he'd held forever and get zero income taxes for that gentleman. We coordinated with his accountant to make sure we had it all lined up, and we just picked off those trade lots of that stock. It was some Apple stock, and we sold a bunch of it.
Yeah. Uh, you know, I think the general rule of thumb is that a fee-only fiduciary advisor adds 1 to 2% of return after the fees just on the tax issues alone.
Yeah, Vanguard has done a study on that among other companies. I had a new client tell me that she didn't realize the impact of capital gains and picking out different trade lots of what she'd invested in her taxable account and whether to sell them or not. We were able to sell a bunch of things for her too and really minimize or zero out those taxes.
Yeah, it's also, sometimes, when we're retired, we'll have maybe caregiving expenses,
Mm.
and caregiving expenses come under medical. And so, maybe in that particular year, you have just a huge deduction. So that's a great year to take monies out of an IRA account.
Yes, exactly. People miss these opportunities.
Yeah,
They
they don't
really
come
do.
around. you know. Okay, let's by the way, I just want to remind everyone that if you do have a question, please use the Q&A and ask. There's a question that just came up, so let me read the question. It says, when you are retired and no longer have a salaried income, can you set up a Roth IRA account and transfer or convert into the Roth IRA account on a regular basis from your retirement rollover account?
You can
So,
convert, you cannot contribute because only people with an earned income can contribute.
right.
But you can take from an existing retirement account and convert to a Roth, and you just want to be mindful of what that's going to do to your taxes.
Yeah. So the good answer is that you got to run the numbers.
Yeah.
Whether it's a good idea for you, it depends on your tax bracket. It depends on whether or not you have tax monies to pay the taxes outside of the IRA and the Roth. So it's not a slam dunk that you should just do it. You
Yeah,
really
it's
need to
not a
run the
slam
numbers.
dunk because it adds to your taxable income, which once you become of Medicare age, there's that 2 year look back that can increase your Medicare premiums based on your income of 2 years prior. But then a lot of people do the Roth conversions because they want to avoid the big required minimum distributions once they come of age, whether that's 73 or 75.
Yeah. But
So,
they also forget a lot of times the California income tax.
oh,
I
and
mean,
California
that's
doesn't give us any breaks, really.
no.
They don't
Mm-mm.
tax Social Security.
Yeah. Let's go back to the slides.
Okay. Just wanted to remind people, think about your marginal
Taxes.
tax rate.
Yeah, you need to know your taxes. You need to know your net worth. Okay.
And as a matter of fact,
Here's a
so
net worth statement.
at least once a year, everybody put this together.
Can you
Figure
make that
out,
a little bigger
sure,
on the screen?
sure.
There we go.
And let me see. So
Yeah, there we go.
on the left-hand side, I've put the assets, what we own. And I've divided it up at the top. We have what they call non-qualified. Those are the things that are not retirement accounts. That's your savings, maybe some cash in an insurance policy, maybe a brokerage account or two that's not a retirement account. Then we have retirement accounts. You can see that I've got a married couple and I've divided it up between who owns what. And maybe there's some stock options. Then we've got some real estate and personal property like cars. Maybe you have bars of gold
Yeah.
these days. And then
Uh,
we subtract what you owe, and I put that over here on the right-hand side.
yeah. When I was at Long Beach State University, I would meet with professors and they had never done a net worth statement. And so we just sat down on a yellow sheet of paper and listed all their assets and then listed their liabilities. And most of them were absolutely shocked that they had as high a net worth as they did because they just assumed being an educator. And it's almost like what you said in the beginning with your parents. They just kind of are scrimping and they don't spend a lot of money.
That's it.
And all of a sudden, that your net worth grows. In fact, I would say that we have more high net worth individuals who ignore their investments than those that are actively trading.
Oh, no, I think you're absolutely right. I think you're absolutely right. They come in the same way with me, and I said, let's put together that net worth statement. Whoa, wait a minute. You've got a big net worth. Didn't you know this?
Yeah, yeah. What I would add, since this is the last session and we're trying to get to all the a little bit of more of the planning part, list your asset and then put the title, how you hold title
Oh,
to
yeah.
the asset right after it. Because how you have title is is very determinative upon death and as far as estate planning is concerned, how it gets handled. So if you have a joint tenancy title, it's completely different than having an asset in the living trust. And if you're married, a living trust absolutely is the best way to have title as far as here in California is concerned, especially if you own real estate. But having a title, the other thing that I think is really important is to know your cost basis.
Oh.
What did you purchase that Apple stock for? And and then the last but not least, the market value. What is it worth today? So that if you take a look at it, the cost basis and the market value, if you were to sell that, you kind of instantly know that, hey, 15, 20, 30% is going to go to taxes, you
And
know?
you could see it right there and understand the impact while you're doing planning around your marginal tax rate.
Yeah, it's so
Funny thing.
important. If you own real estate,
Oh,
apartment buildings, I recommend highly that you figure out what is your net income, and give the time that you put into that rental property a value, $25 an hour or whatever, so that you can kind of see what is my return on this particular investment. And the more you know about your finances, the better off you're going to be. We're always worried about what's happening in the country or what's happening on the news tonight. And that's not where it's at. It's really about knowing your particular circumstances, knowing your particular goals and your financial situation. We really want to dig down into that so that we get a sense of where you are. You know?
and you make a really good point on titling accounts. A lot of times people will not have gone to the trouble of getting a will and trust, so they'll put beneficiaries on their taxable accounts, like their savings account, their brokerage account. And I'll say, well, it just says transfer on death. It doesn't say to whom. And I'll say, who's your beneficiary on the account? And they won't remember.
Yeah.
They can't remember.
Beneficiary designations, please put that with your estate planning documents. I also recommend highly that if you do have a financial advisor, talk to them about who you should name as your successor trustee. Who should be the executor. Talk about that. We're living longer.
Yeah,
And the issue is not just that we're living longer. I mean, the good news is that we're living longer. The bad news is we're living longer.
that's right.
So we want to be able to have a good quality of life. Who is going to be there for us to help us? You
Yeah,
need
you
to
should
do
review
that
it all
in
the
your
time.
60s and 70s and 80s if you're still living so that you can prepare for the 90s and the 100s. How
That's
long do you
exactly.
have your clients live?
You know, my clients are typically in their 90s.
Yeah. Yeah. But for your when
Oh,
you
for my
do
planning
financial
purpose,
projections,
we start at age 90, and then we talk about what their family history is like and what they feel based on their medical history they could expect. And some of them say, well, my mother's 97 and my dad's 98, and I'm feeling great and my health is great. I think we should at least put 95.
yeah, yeah, yeah. It's a number. Let's go to the next slide. but it's anything that you've learned in the last 6 weeks, it's financial planning is a number crunching exercise.
I think when I made it larger, I did something to it. Let me see if I can get to the next slide. Hold on a second.
But it's a number crunching exercise. So
Definitely.
whichever your net worth is, what your cash flow is, if we know how long that you're going to live, how much you're spending on a monthly or annual basis, we can also once we know all those things, then we can determine how much risk that you need to take or how much monies do you need from your investments to live comfortably.
Well, I'm glad you brought up the R word.
Yes, risk management.
Because one of my favorite topics is at the very beginning is to make sure when I know the client's net worth that I can figure out if they have enough insurance to protect their net worth. Now, we all need to think about our health insurance, whether we still need life insurance, and whether long-term care insurance fits in our plan. But I think people forget that they need to pull out, after they figure out their net worth, they need to figure out if they have enough auto and homeowners insurance, liability coverage to protect that net worth. And a lot of times people are underinsured. They're missing that next policy that could give them the additional coverage, which is called an umbrella liability policy. If you get nothing out of today's presentation, make sure to pull up your net worth, calculate your net worth, pull up your auto and your homeowner's declaration pages that tell you how much coverage you have. If you have an umbrella policy, pull that up too and compare it to your net worth. Make sure you have the right coverage. Talk to your agent about it. You don't want, you don't want to be at the point where you lose what you've taken so long to build.
Yeah. And umbrella policies are relatively cheap in the insurance industry.
Relatively
So,
cheap. They're in $1 million increments. It can depend on where you live. LA can be a little bit more expensive than Orange County. If you're covering other family members like kids or, adult kids or other people whose driving records may not be that good, you may not be able to get the umbrella coverage you need. So I've actually had clients kick their kids off of their auto insurance so that they can get the umbrella coverage they need.
have you talked about any clients that where fire insurance for their home, as far as fire is concerned, is a major issue for them?
Yeah, I have two clients right now who've lost homes in the Altadena fire, and I had a couple of people, they have not lost their homes yet, but their fire insurance was canceled and they were put on the FAIR plan. And you're really not quite sure how much that's going to cover and what your risk is. So,
Yeah, and that's
ugh,
going to affect your umbrella policy as well.
absolutely.
Yeah,
So you
yeah,
can't ignore this. You need to make sure that we're worried over here about fires, but what if you get an offender bender and it wasn't your fault, but the other guy has a better attorney than you do and has more insurance?
yeah, yeah. It's
It's really too bad.
we're
So
not in Kansas.
we're not in Kansas.
Risk managed life insurance. Hey, if you're past, if your kids are out of school and are making money, do you still need life insurance?
Probably not. And so the one proviso I would give everybody is that if you have the type of life insurance or even a term policy, but if you have a cash value policy, it has some buildup of cash. Let's not just automatically cancel it and cash out. Let's figure out what you have, what the impact would be of different actions you might take. I mean, heck, there are companies out there that'll buy your policy from you.
But by the way, whatever you hear in these programs, that's exactly what the best advice is. If you have an old annuity, don't just get rid of it. Let somebody analyze it. If you have a partnership, let somebody analyze it. Because every single time you make a change, it's going to cost you money and it's going to have a tax impact.
That's right.
So, don't, again, don't listen to gurus on the TV or on the radio. They don't know your situation. So take that policy in to someone who is not an agent, okay? So somebody who has some insurance knowledge that can review those policies.
And people need to understand when you come to an advisor, a good advisor is probably going to pull in your accountant and talk to you if it has a big impact. I mean, I remember a client who had a lot of cash value in a life insurance policy. We got on the phone with his agent to think through our alternatives, and then we got on a conference call with his CPA.
Yeah,
You
it's
don't make any sudden decisions.
no. And you just need to know the questions to ask. So
Exactly.
so the bad news is the more stuff you own, the more complicated your life is.
Yeah. The
And
more it owns you.
yeah, keep it simple, stupid,
That's
as
it.
we get older.
Now,
What's this
sometimes,
slide about?
pardon, this is just making sure that you're getting the most for your savings. Interest rates are likely to go down from where we are now. We just don't know when. But a lot of people have money sitting in a bank that's not earning as much as it could. You have to take some effort, but you can go to an online high yield savings account, might give you up to around 4%. You could go to a money market account. Vanguard's one of the higher paying ones. They might pay you somewhere around five, almost four and a quarter.
What is Schwab paying on the money market funds?
They have a Schwab Treasury money market that I use that's 4.03% right now.
And why is the Treasury, what's the advantage of having a Treasury money market fund?
Well, two things. First of all, we want to make sure that it is of the highest quality. So that's U.S. Treasuries. And second of all, it is free of California income tax, which means you get a little bit more for your money than you think you do, getting back to your tax rates.
Yeah, yeah. Um, does Vanguard have any offices locally, or is it all online and by
Yeah, it's
telephone?
all online. So when people are thinking about brokerage accounts, I encourage them to first think about those that you can go walk in and talk to somebody like a Charles Schwab or a Fidelity. You may have some other locals that you know that you have friends who use them and trust them.
Yeah.
But that's what I talk to people about doing first, is thinking about somewhere where they can go visit their money.
Yeah.
They're not really visiting their money.
Uh, uh, Credit unions, they usually give a little bit of a higher rate.
They certainly do. So I figured you were talking about brokerage firms, but in terms of banking, I love credit unions.
Yeah.
They only make money by lending to their members. They can't issue stock. So
Please.
I am a big fan of credit unions.
Yeah, me too, except for one exception. They sell an enormous
Oh,
number of annuities.
it's really sad that they've gotten this pressure over the
Yeah.
last few years to
So
do that.
please
It's
stay
very
away
sad.
from their annuity desk. That person they're on commission, and it's not in your best interest.
It's very
So,
sad.
what is brokered CDs?
You can actually go to a brokerage firm like a Vanguard or a Schwab or Fidelity, and you can buy and sell CDs, and we refer to them as brokered CDs because you can buy them through a brokerage firm. And you're not locked in with a penalty if you get out of it early. You're just buying it and selling it. Now, I'm not saying to trade it, but I'm saying that if you want to park some money in a CD, you have good reason to believe you can lock it up for a certain period of time, but then it turns out you need to shake loose some of that money early. You can simply sell some of it without any kind of 3-month penalty on interest. You
Yeah,
just are faced with selling it into the current market.
yeah.
So you have to figure out what that's going to, if that's going to get you the return that you want.
And that gets us back into cash flow.
Yes.
When do you need the money? You need to know that, because if you lock up your money for 9 months or a year, that means if you have to turn that in, you're going to have pay a penalty, and that ruins your yield on that investment. So, liquidity is really important.
Yeah, people don't think about you have to actually give every dollar a job and give it a time frame. This money I'm going to need in June, so I'm going to put it in my checking account. This money I need a year from June. Maybe I can put it into a CD for 9 months or a year.
When somebody becomes a client of yours, Delia, do you say, okay, we figured out your cash flow. You need X amount per month. Do you just then you use Schwab as a custodian? Do you just set it up with Schwab to say, okay, transfer $10,000 per month to your client's checking account?
Yes, not only do we automate it, we may automate the sale of their money market fund to get the money lined up to get out at a certain time. I talk to my client on what day do you want that money? What day in the month do you want that money to arrive?
So you try to make it so like when they were an employee, this is what they're getting.
I have a client who's been paid twice a month when he was working, and that's when we send him money. So that's what he's used to.
Yeah. Let's go to the next slide.
So at this stage, we may all be thinking about grandchildren. I want you to think about tax efficient ways to save and contribute for a college plan. So these 529 plans are really good for advanced education, but they're also now can be used for kindergarten through 12th grade.
Or if you want to go to Paris and you want to go to a cooking school, you can use your 529 plan.
That's exactly it. They qualify for any school that is eligible for federal aid.
Yeah,
So maybe the Cordon Bleu in France. I think every
exactly.
family ought to have a chef. So there's a website for this for savingforcollege.com. There's a Vanguard 529 comparison tool for their 529 plans.
Yeah.
Um,
And this is a brand new.
Brand new. People often say, well, I don't want to put money in a college plan because I think that I'll put too much away and the kid will have more money in that plan than they really need. And now the government has said, tell you what, if the plan has been open 15 years or more, and if the beneficiary is now working and would otherwise qualify to contribute to a Roth, you can transfer that Roth amount every year up to that annual limit, up to a total of $35,000 over a period of time, and give them a head start on a retirement plan. I guess it's just great.
Yeah.
It's just a wonderful benefit.
Yes, it is. Let's go to the next slide.
Yeah. There are also versions of the 529 plan for people who have disabled children. This is very handy for people who want to put some money away so that the child could still qualify for state and federal aid, but they wouldn't be seen as having too much money. And it's a nice interim step before you're thinking about or need to put together a special needs trust. But if you have that kind of person in your family, you really need to consult an attorney. Really do. But this can be very handy. So I just want to flag it so that people know about it. It's in the slides. And then Pete, you've been talking about the importance of an estate plan.
Yeah, I just want to go back to a little bit on the on if you have a special needs child,
Yes.
um, hire a fee-only fiduciary advisor, please. Um, you know, I'm going to use Merrill Lynch as an example. Merrill Lynch offers to their brokers a 1 to 3 hour course on on a special needs trust, and they give their brokers a special designation that they're now experts in the special needs trust area. You know, they're not. And that designation is given in-house. It's not done by an outside credentialed agency. And it's all about, again, selling product. And so if you have a disabled or a mentally disabled or somebody who's a special needs, please see a fee-only advisor because there's lots of alternatives and it's complicated because you've got to set up not only the legal documents but the financial aspect of it,
And the team that's going to help manage it.
yeah, it
I
takes
just
a
went to
team.
some continuing education unit training yesterday through my financial planning association. We listened to an hour-long presentation from an attorney who handles special needs trusts.
Yeah,
Every time I hear these presentations, there's so much more to it, you
yeah,
know?
yeah. Let's go
There's
to the estate planning. We do a 6-week program on estate planning. Um, we encourage you to listen or to view it if you need to know about it. But just remember title, title, title. How you have title to assets is a real key as to who's going to take care of you if you become disabled, or you get dementia, or you get a stroke. Who's going to be there to help you, to be an advocate on your behalf? And it can't just be, hey, my friend volunteered to do that. They need to have what's called legal authority to act on your behalf.
And
And
I'll tell you, sometimes people give these titles as an honorarium. I had a client who said, I said, well, you've got a trust. I said, who are the backup trustees? And he said, oh, well, my wife's two sons. Well, he had just been telling me how terrible these sons are with money. And I said, they're the sons. And he thought about it and his eyes got real big with horror. And I said, you need to talk to your attorney. You need to talk to your wife and you need to talk to your attorney.
yeah, I recommend people talk to their financial advisor, because you understand more about the family dynamics and you understand money. Attorneys are terrible as a group as to knowing anything about money. It's we have this, oh, you're an attorney or you're an educated individual, therefore you should know about money. It's just not true. We had Mark Hebner from IFA on last week,
Hmm.
and his firm is now a little over $5 billion.
Hmm.
And how he got into it was into the fee only financial planning world was he sold his company at a very young age and received an immense amount of monies, and he had it with a brokerage firm for 12 years, and then he discovered that another friend had a wife who needed some help, and he started reading books, et cetera, et cetera. And that's when he realized that, they're not working in my best interest.
Hmm.
And he belonged to an entrepreneurial president's club, and he found that other very wealthy entrepreneurs had no clue about managing money.
That's crazy.
Well, but it's so true. Accountants, they're accounting. They don't do financial planning.
No.
Attorneys, they don't do financial planning at all.
Yeah, I have attorneys
Um,
as clients.
Yeah, businessmen. If you're in business, you know your business, whatever business you're in, whether it's manufacturing, woodworking, auto, whatever it is, that's what you know. And you're smart, but you just don't know this financial planning part. So please make sure you have your estate planning documents. Procrastination is the number one reason why people don't have their plans.
And once you have these documents, pull them out every now and then and make sure they're up to date.
Yeah, yeah, exactly. Let's go to the next slide.
So, a lot of people,
By the way, most of our audience members are already retired.
so you want to take a look at how much income you have from all of these sources, when your RMDs are going to kick in for your IRAs, the impact on your marginal tax rate. We don't, and when you start investing, or if you're investing for younger people, compound interest is really important. It's important now, even if you're retired, right?
Yeah, if you're 70, you got another good 20 years
We certainly
for
hope
your money
so.
to grow.
Yeah, yay. Yay.
Yeah.
So, if you're trying to save for a goal, and this looks like retirement, but what if you were saving to put a grandkid or great grandkid to college? If you can put in a little bit at the beginning, it's going to grow faster than if you wait until later years.
Yeah.
And so, Social
Good.
Security, most people may be getting Social Security already. So these are the maximum benefits that people today would be getting from Social Security if you filed in 2025. So
Do you have a asset allocation chart?
no, I do not believe I have an asset allocation chart. I know
Okay.
you like,
Talk a little bit about that. Why should somebody know? Well, first of all, what do we mean by asset allocation? And second of all, why is it important that we know what that asset allocation is?
asset allocation is the mix of your investments of different asset classes, stocks versus bonds, types of stocks versus types of bonds, stocks that are US versus international. And by the way, this year, diversification of these asset types, including international stocks, you would have done better than just US stocks. Diversification would have won the year this year is winning right now. International stocks are up 12 to 15% this year. S&P 500 is up maybe 1 or 2%.
Yeah.
It's
So
been a
the two
wonderful year.
keys, two keys on investing is your asset allocation. Besides asset allocation, diversification, diversification, diversification. Do you use index funds or are you an active manager, Delia?
I tend to use index funds because the costs are the lowest.
And
I
it's
may,
tax efficient.
and they're tax efficient. Of course, it depends. I mean, they're tax efficient. It depends on whether you have the investment inside a retirement account or inside a taxable account. And experts are saying that even in retirement, we need somewhere between an allocation between 45 to 75% stocks in order to maintain our income and beat inflation in our retirement years.
So for most of your clients, you're recommending usually then a 60-40 portfolio.
Could be 60-40 for clients who are really upset about risk. I may say, let's take it down to 45. But again, they need to understand that savings accounts do not beat inflation. And when we're retired, a lot of our expenses are higher than inflation. Our medical or dental expenses might get larger every year. They may grow higher than regular inflation. So we need some of that money to be growing to beat inflation and be there for us when we need it in the future years.
Yeah. One of our questions that we've received is that I have a special needs brother. Can I create a special needs trust for him? And the answer is absolutely yes. The earlier, the better, because you don't know what will happen to you or and he says he had a stroke 10 years ago and cannot live alone. Yeah, man, boy, absolutely. There are elder law attorneys that are really specializing also in special needs trust and recommend highly that you work with a fee-only financial advisor and the estate planning attorney and to develop a plan for your brother.
Yeah,
Uh,
Pete, what do you think of the National Academy of Elder Law
I
Attorneys
love them.
Association?
I've really have had really good luck with them. It's
Great.
called NALU, the Academy of Elder Law Attorneys, and they specialize in elder law issues for people who are government benefits, and they're excellent. Um, Another question is, I'm not getting a dollar amount you displayed for Social Security. How do I find out what amount is correct for me? I'm 70, started my Social Security at 70 with the removal of the WEP, and I'm getting,
Windfall elimination provision. I know what
okay.
that's all about.
Oh, you do.
Oh,
Okay.
yes.
Um, where can they go to?
Well, If they're if they're age 70, they should be able to go out to the Social Security website and find out what their benefit is.
Yeah.
And the good news is because that law that was passed just in January, they are no longer affected. Their Social Security is no longer reduced by a pension they received from a job where they didn't pay into Social Security. And that's called the windfall elimination provision. So not only are people receiving all of the Social Security that's on their Social Security statement, but if they had filed for Social Security last year as well, they're getting a catch up on that money as well.
Yeah. She said she went to the Social Security website, but it only displays her current benefit.
And if she had, so I'm thinking that if she had filed before this year and had the lower benefit affected by the windfall elimination provision, she should soon be hearing from Social Security
Yeah.
and
Do you know?
receiving a catch-up amount.
Yeah. Social Security is it's very complicated.
Yeah, it can be.
So try that 800 telephone number and be on the website, and the person that you have on the phone will guide you through the website to get what you need.
And I believe the people that I've been hearing about who have been affected by this change in the law received some correspondence from Social Security that told them that they were going to receive this bump up.
Yeah. They're,
So
they're,
maybe it
they're-
was,
they really try to be helpful.
they do. I
Yeah.
mean, we hope that they're staffed at the level that they need to be, but they do
Yeah,
try to be helpful.
that's a whole nother topic.
Another question.
Yeah. Should the Roth IRA account be set up or managed as a trust account? Absolutely not. Okay. Roth are individual retirement accounts. And so if you add a trust to that, even as a trust as a beneficiary, it's just not advisable. But again, you need an estate planning attorney. We recommend highly that you look at our retirement planning session on the It's Your Estate. Michael Simon did that presentation, and he just did a really an excellent job on that topic.
Nice.
Let's see, is catch-up amount all Social Security income is pretty much taxable? Is I'm assuming.
No, actually, up to 85% of our Social Security may be included in taxable income, but up to 15% of it is tax-free. And that's on the federal side. And of course, California does not tax Social Security. So this is again where you need to take a look at where you are in your income. And I don't know if you have this available to put up on your website, but this little two-pager that I showed everybody also has that list for how much of your Social Security gets thrown into the taxable
Where is
column.
that? Oh, there it is. The Social Security.
That's exactly right. So the taxability of benefits, if you, as an individual, you have less than 25,000 of income, or married filing jointly less than 32,000, then all of Social Security is tax-free for federal. And then the worst thing that can happen is that 85% of the Social Security is considered taxable, but 15% of it is going to be tax-free.
Yep. Need to know your taxes.
Need to know your taxes. Need to know your taxes. So I just wanted to remind people that you may think your required minimum distributions are going to start at a certain age. Some people do not realize that the laws were adjusted in the last couple of years. Now the starting age is age 73 for most people, and it could be age 75 if you were born in 1960 or later.
You
And
know,
this is when you have to start taking out a minimum amount from your retirement accounts.
the partnerships, oil, gas, real estate. If you buy them, especially private ones, please calculate your after-tax return. Attorneys and accountants charge almost double or triple to do those kinds of tax returns.
Oh,
I
good
just
point.
had a tax return from one of my clients, was 85 pages because of a private partnership on solar. So
My
the initial
gosh.
return rate looked really good. But after you take into all the tax issues involved, a normal investment would have been better, and it was illiquid as far as the sale of that asset.
Well, that's
So,
crazy.
you need to understand your after-tax return. What is phase two, Secure Act two?
Phase two is, you're talking about this chart that we have right
Yes.
here. Yeah. So while we were all worried about COVID, Congress was getting together and deciding that they wanted to stretch out when we would start our required minimum distributions, and that impacted how we inherit our IRAs from people who aren't spouses and how long we have to take the money out. So this phased in timeline is for when we start our required minimum distributions from our retirement accounts.
Let's
So
go to
what
the
you were
next slide.
Okay. I put in some slides about calculators. There's a great website called dinkytown.net that has all sorts of calculators. If you wanted to project retirement, if you wanted to decide whether to take a lump sum from a pension or whether to take a payout. So I included some snapshots of what a retirement pension planner calculator looks like. You're going to retire and you have a pension. This is not to replace an advisor because an advisor can talk to you about the assumptions here. Some people will say, well, of course I save a lot of money. Well, I don't know that you save 8%. Well, of course I'm going to get a certain rate of return. Well, not based on your investments.
Yeah.
So there's,
Garbage in, garbage out,
that's exactly it.
and but the point is you gotta do the calculations. It's one of the reasons why I do not manage my own money, because I am not a calculator. I don't like running numbers, and and my gut usually is wrong when it comes to picking an investment. So it's having a fee-only fiduciary advisor. I'm a thorough believer. What
Now,
is this chart?
this is talking about cash flow. Now, people say, well, I'm going to retire, and shortly before they retire, maybe they'll fix up the house and they'll get a new car, and they say, okay, I'm going to retire, and this is what 30 years are going to look like. Well, advisors are like, no, 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 wait a minute. In our experience, retirement can be divided up into phases. There can be the starting phase where everybody's healthy and we want to go and use all of our money to have our best times. We call that the go-go phase. But then, sometime in the middle of your retirement, things may slow down. It may be that now you've got grandchildren in town, and so you're spending more time with them and you're not traveling. Maybe your health has had some issues, so you're not traveling like you used to. We joke and call that the slow go phase. This might be when you don't spend as much as you did the first third of your retirement. Although in the last third, you may wind up spending more, even though you're not traveling and putting out money on other things, you may be putting it out on medical. Even for routine things like cataract surgery or hearing aids, you may have to shell out some money for special lenses, for the devices, not to mention special dental that you may need. So you have to know that retirement is not just one 30 or 35-year block of being the same person with the same cash flow needs. You may have special needs at different times. And that's what an advisor wants to talk to you about.
And there's nothing wrong about selling an asset.
Yeah.
People think that um, they will not sell an asset because of the tax ramifications of that asset, and therefore their cash flow will be diminished. And if their cash flow is diminished, then they feel poor.
Yes.
There's so much psychology involved. It's in managing money for other people. Would you say that the numbers are the easiest, and getting to understand the psychology of people is probably the more difficult.
Oh, absolutely. The numbers are just the start. That's when you talk to people and you say, well, what does this mean to you? Well, I want to help my kid, but I don't like his spouse. How do I give money to them and not give it to their spouse? Well, that's a big discussion. I've got a rental property. I want my kids to inherit it, but I have three kids and I only have one rental property. And
Yeah.
can they afford to leave it as an inheritance? Maybe that asset, as you say, is better served to take care of their long-term care needs.
Yeah. Is it better to purchase a reverse mortgage, or is it better to buy down into a smaller place?
Yeah,
It's
exactly.
there is never, you know, when it comes to managing money, there is no golden answer. There's always advantages and there's always a disadvantages. And you got to kind of talk through them to see what is the best alternative for them. I mean, do you make up the decisions for your clients?
Oh no, no, no. A lot of this is a discussion, and they go away and they think about it. Um, and a lot of this is a preliminary discussion, and then they go away to think about it, and then something happens to a friend of theirs, and they're like, "Oh my gosh, now I understand. My friend couldn't stay in their two-story home. They needed to sell it and go to a continuing care community. Maybe my husband and I need to think about doing the same thing."
Yeah. Let's go to the next slide.
So this is another way of stacking this money and thinking about your cash flow and your assets on your net worth statement in terms of what the money is needed to do for you. So this is a good way of looking at this. This is from a guy named Wade Pfau. I have him listed in my resources. He says, listen, at the very bottom, we need to build a foundation of an emergency fund. We all need an emergency fund. You can call it your reserves. It's for liquidity. It's money that is there that we don't have to go and sell something special. Maybe this is our savings account. Maybe it's cash in our insurance policy. Maybe we need to tap our home equity. Maybe you have the bank of mom and dad, but this is what you need for emergencies or contingencies. At the very top, what we call your goal is to live a long and healthy life. The asset that you would tap would be your reliable income. This would be Social Security and pensions. Maybe you have some annuities that pay you a regular income. Maybe you put together a ladder of bonds or CDs that mature at a certain time. So they're going to be available for you year from year. When you think about your spending needs, you ought to say, well, how much do I need in my cash flow to keep the lights on and keep fed? And that's going to come from my reliable income. Those are essential expenses. But my trip to Paris or my gifts to the kids, that can come from a diversified portfolio. Those are from my investments. And that's where I use money for lifestyle. I use money for leaving an inheritance to my kids. I have some people who shave off a certain amount of money in their retirement accounts. They may even take it as a separate retirement account and say, I'm leaving that one to my kids. I'm going to invest that 100% stocks, and I've put my kids down as beneficiaries. Or
Yeah.
they'll do that for charity.
Yeah.
I have several clients who've done that for charity.
Yeah. I had a call the other day. A woman was 97 years old and she had a $300,000 portfolio. And she was wondering whether or not she could give $20,000 to one of her grandkids who needed some help in college. So we just kind of talked through it because, you know, money is security.
Money is security.
And so and once you give it away, you can't get it back.
That's
And
right.
so she just needed to be comfortable. I mean, if you can't give away $20,000 at 97 and you have a $300,000 portfolio, it seems so obvious that you can do it. But if you're involved in it at the time from that person's perspective,
Oh, yeah.
it can be a little scary,
Very scary.
you
But then
know?
you ask them about their reliable income, and you ask them about the equity in their house, and you ask them about,
Yes.
what their
They weren't
needs are.
spending the reason why it was 300,000 because they weren't spending that in retirement, that particular investment account. You mentioned bonds. how bonds affect a portfolio in a number of ways. They provide income, but they also give it some balance. They minimize the volatility.
That's
But
exactly right.
but they also allow you to tap into that bond market and not touch the equity portion of the portfolio.
That's right. That's right. And more in the last year or two, we've had really good interest rates. I've been putting treasury bonds in client accounts. It's been really good to know that the money's there. You can buy individual treasuries, and if you hold it to maturity, you're going to get your money back plus interest.
A question. I always heard that when one retires, they move into a lower tax bracket. Is this still a common thing? I don't see myself moving into a lower tax bracket because of my pension, Social Security, and investments. And I think her point is absolutely relevant today. That
No, absolutely. We like to joke that if we've done our jobs correctly, you'll never be in a lower tax bracket.
Yeah.
But a lot of times people don't realize that they say, well, now I'm going to be in a lower tax bracket until those required minimum distributions start. And then suddenly they have to take out a lot more. They have to take out a certain amount of money. They have to be kicked into a higher tax bracket because they didn't do some planning earlier to recognize, to realize that they're going to be in a higher tax bracket, and maybe they should manage that as they approach that required minimum distribution
And,
age.
and and again, there comes in the planning on whether or not you ought to transfer some monies into a Roth. It depends on age. It depends on your income tax bracket. There's so many factors. But remember, if you're paying more taxes, that means you have a higher income.
Yeah, good
That,
news.
that's a good thing.
You should be happy.
Yes.
So this
What
is
are
when
qualified charitable distributions?
This is when I want to point out to people, if you're charitably inclined and you are 70 and a half or older, and you have retirement accounts where you have to take required minimum distributions. So has to be an IRA. In this case, it has to be an IRA. You can actually look at that required minimum distribution. Let's say it's $10,000 this year. You usually give 4,000 to charity. You can write that check, give that gift out of the IRA, and it will count towards that RMD. Now, a lot of people know about these qualified charitable distributions, these checks through their IRAs, not a 401k, not a 403b. But I think they're missing a great opportunity to do something else with that IRA. When you hit a required minimum distribution age, you may find out that your RMD is pretty big. And you may say to yourself, think of this logic. I'm going to take this RMD. Maybe the RMD is $60,000. Now I'm going to say this as a planner. You can have $1.2 million, $1.3 million in an IRA. You have to take out about $50,000 to $60,000 out of that IRA and pay taxes on it. So maybe I'm going to have a client who says, well, I'm going to take that RMD, I'm going to pay the tax, and then I'm going to invest in bonds that pay me a regular income because I'm afraid of this market. It's been a crazy year, and I'm going to feel more comfortable with just a regular income for the rest of my life. Well, people are missing out on a very important provision in the new laws that give us the opportunity to use up to $54,000 of that RMD, once in a lifetime opportunity, for a charitable gift annuity. Now, you can also do these CRTs or other things. That's much fancier. And, Pete has advised me and others in these seminars that a lot of times these other fancy annuity trusts are a little bit beyond what we need to go through. But you can approach a charity and take a look at that $54,000 lifetime limitation. And if you've got this big RMD, you can spin off this money directly to the charity out of the IRA. It counts towards your RMD, and that gift annuity gives you a lifetime benefit, a lifetime income for either yourself or you and your spouse. So I put together a spreadsheet or a chart, and I really want people to understand this. Now, how does this work? The Gift Annuity Association and the charities, they have a certain interest rate they will give you on your money for the rest of your life based on your age and the year that you contribute the money. So what I did was I looked at this in March of this year and I said, okay, on the far right-hand side, I've got an individual or a couple that's going to take advantage of that lifetime $54,000 for a charitable gift annuity, a CGA, at age 73. And I looked at the gift annuity payout charts. Now, a single person is going to get 6.7% on that 54,000 that they gave to charity. But if I have a married couple, and let's assume that they were born the same age just to make this simple, and let's also assume that they're doing that full 54,000, their interest rate for joint lifetime. So if one of them dies, the other one continues to get the income. That joint lifetime interest is 5.9%. So here I am, if I've got a single person, they gave 54,000, they're going to get 36.18 a year for the rest of their life off of that $54,000 gift. Now, what if they say, oh my gosh, I can't give that much money to charity. I'm going to take that money, pay the taxes, and I'm going to invest it myself. So I say, all right, here's what I'm going to do for you on this chart. I'm going to say at a certain tax rate, you're just going to pay federal taxes. I'm not going to mess with California. And let's pretend that you're going to get the same interest rate, which I doubt, but let's pretend that you're going to get the same interest rate on your money the rest of your life that that charitable gift annuity would promise you at the very beginning that you would get for the rest of your life. So let's just make that even. Let's not even argue about what rate of return you're going to get. Let's just focus on the tax, after tax return, because it's not what you make, it's what you keep. So let's say that I've got a single person who takes that RMD at a 22% marginal tax rate, federal tax rate. They clear $42,120. So they don't get the whole 54,000 at the 6.7. They get the after-tax amount of 42,120. They invested at 6.7%. They're going to get an annual income of $2,822.04, not 36.18. They're going to get 28.22. The joint lifetime, if that couple could get it for the rest of their life, they're only going to get a little over $200 a month. You can do this in an annual amount, $2,485.08. The higher the tax bracket, the less money you make on this amount of money. When I look at these numbers, I'm just like, well, if you have a charitable intent, number one, but then some people say I couldn't possibly give 54,000 in 1 year to a charity, or 27 and 27 to two charities. But I say to them, what are you going to do after you pay taxes on that money? Are you going to just invest it for income? And that's where I feel the truth gets shaken out on what the better deal is. If you think you're just going to invest it for income, I think you're better off having the charity give you an income for the rest of your life. That's my speech. I mean, I feel really passionate about this.
Yes, you are. I love it. Well, the
Well,
thing
but
of
it's
this is,
just,
it's an kind of an oxymoron, and I'm giving money away and I'm
yes,
making money. Come on,
that's
really?
where people get very nervous. And I'm
Yeah,
like, but look, who doesn't like a pension? Who doesn't like guaranteed income just
yeah.
showing up in the
And
mailbox,
just
right?
remember that the income that you do receive from a charitable gift annuity from an IRA account is taxable income. So,
Sure,
depending on
sure.
your income tax bracket, but it's a great alternative. Crunch the numbers.
It
It's
really
not
is a
what you
great
think.
alternative.
And by the way, the charity doesn't get to spend that money until you die.
That's it.
Okay, it's set up in a special account. They can't spend it, and they have to give you the income for the rest of your life. And most gift annuitants, by the way, live longer than the rest of us. Let's
That's
go to
pretty
the next
exciting.
slide.
Okay, so what do we know about planners? Well, you want to find out who they are and where they work. That's what we've been talking about. Are they independently registered? Are they fee only? Or are they associated with a firm where they're going to have to be beholden to the firm and what the firm tells them to do instead of being independent? How are they paid? Ask them. Is it only a fee or do they also get a commission? Do they get referral fees? This is what we've been talking about from the very beginning of the presentation.
You
Um,
know, let's I've, uh, before we get into this slide, because I think we've uh, can hit the nail on the head. If somebody wants to do it themselves, they know their cash flow, they understand their goals, they don't want, the last thing they want to do is go to a financial advisor. What would you suggest that they do?
I would suggest that they take classes like this.
Yeah.
No,
But how
seriously.
would should they invest their monies? I mean, should they go to a Vanguard and get a lifestyle, one of those lifestyle
Yeah, I think
funds?
if you want to do it with simplicity, I think that one of those target date funds that gets less and less aggressive with stocks and more conservative over time can be good. But I also like Vanguard's life strategy funds because they pick an allocation and they stick to it.
Yeah.
So if you say, oh my gosh, I just want to stay 50% stocks, 50% bonds, and I want to stay well diversified, and I don't want to have to worry about rebalancing when one section gets bigger than the other, and then I have to do the math. The Vanguard Life Strategy funds will do that for you. If you want a 50-50 mix, 60-40, they've got one that I think it's the Conservative Growth Fund.
Yeah.
Pick one of those. There's only four of them. Pick
Yeah.
one of them.
Or there's a Vanguard has a fund that's called the All Market Index Fund.
There's a Stars fund, sure.
Yeah, it's just so cheap, less than 10 basis points
Absolutely.
on annual basis. That gives you exposure to every stock in the US market. Pick out an international fund and pick out a bond fund. I
Absolutely.
mean, literally three funds and you're there.
There you
There
are.
is no secret sauce. You know, the investment part is quite boring. It's the planning that's the difficult part, crunching those numbers, making the decisions that we were talking about.
Yeah,
And
the
that's where
investment is just a tool to accomplish the goals that you've set up with the cash flow that you're going to need and allocating it the way you need to allocate it. It's
yeah,
just the investment is just the tool.
that's why we say number cruncher. Okay, you need a number cruncher. Let's go to the next slide.
So this is where you can see the credentials that the different advisors might have. A lot of us who are financial planners are going to be certified financial planners. We're going to go through 2 years worth of a program. We're going to go through an exam. We're going to have to pass the exam, have 2 to 3 years of supervision before we can even use the designation. Then we have to have continuing education units of 15 hours a year. We have to have code of ethics training for 2 hours every 2 years. I mean,
But
we
it's
have to
kind of like it's beginning, the experience and the rapport
Oh,
are just so important,
yeah.
you
Yeah,
know?
the things that I've learned in these
Yeah.
decades.
Yeah. It's just amazing. And just because you have a CFP does not mean that the person doesn't charge you commissions.
Well, that's exactly it. That's
So,
exactly it.
how are you paid? And you got to have rapport. By the way, when I was at Long Beach State University and I asked the professors, why did you pick the advisor that you did? Because they were so nice, and I think it's really important that rapport and trust, that's where I think they mean nice. But please, that's not your first choice.
No,
How are they paid?
and make sure that they work with clients like you.
Yeah.
Like
Let's go to the next
like the
slide.
person who asked the question about windfall elimination provision, If they
Yeah.
don't know what it is, maybe that's not a good person to work with.
Yeah. Let's go to the next slide.
So here's where you may find some advisors. You may start searching. The Financial Planning Association will include both commission people and fee only. because it is the largest association in the country. The last one, the National Association of Personal Financial Advisors, that's only going to be fee-only people. They're more likely to require you to bring them money to manage in addition to give you advice. So you have to figure out, exactly what you're looking for, what kind of help you need.
Yeah. And by the way, if you're going to be looking for an advisor, please review or meet with at least two, maybe three. It's a great educational experience
Exactly.
because they're going to kind of give you an idea, feedback as to where you are at the present time. And you need to hear that from a professional, and it's at no charge. So highly recommend it. We've got about 10 minutes left. Delia, Eugene, why don't you kind of open it up and see if anyone has questions that they want to either talk about verbally or
Okay. Hand raising is allowed now.
hand raising is allowed. Now, what do you mean by hand raising?
If you tap on the screen or move the mouse, you should have an option at the bottom. There you go. Someone tested it to raise your hand, and at the end of the session, we'll open up the mics so you could ask it live.
Can we do that now?
Yeah, I'm just waiting to see if anybody raises their hand.
One of the questions is the Voya chart easy to find online?
Yes, but I could certainly send it to you so you can upload it and post it
Okay.
or put a
Just,
link to it.
why don't you put your email address and contact information up on the screen?
Oh, sure. Let me go back to my slides. Let me go find this and go back. Waiting to share and then go back up.
There you go. So send her an email and she'll send you the link, or will send you the PDF on the tax
Sure
chart.
thing.
But if you Google, I think income tax rates, I think you'll
Yeah, I
find
think if you put in 2025 tax update Voya PDF,
yeah.
they're
There's a
pretty,
lot of companies who provide that kind of information.
and it's all free. It's a little easier to find the first 2 weeks of the year. After that, it gets real, the screen fills up pages and pages and pages. But I look for them the first 2 weeks of the year. Sometimes they'll even come out the last week of December. And I pick up from 5 or 6 different companies.
Yeah. The question is not there's so much information out there. The question is what information is good and reliable. And when you're clicking around on Google, they remember what you've clicked on, and you get more information, whatever area. I start seeing things on my regular internet searches. So be careful. I mean, Eugene has warned me many, many a times that the internet can be your friend, but you got to be very cautious.
You really do.